Welcome to Market Overtime. I'm Caroline Woods on the floor of the New York Stock Exchange. Our guest today spent 9 years at the Federal Reserve Bank of Dallas and was an advisor to Fed President Richard Fisher throughout the financial crisis until 2015. At the Dallas Fed, her work focused on financial stability and the efficacy of unconventional monetary policy. She is the author of Fed Up, an insider's take on why the Federal Reserve is bad for America, and currently the CEO and chief strategist of QI Research. Please welcome Danielle DiMartino Booth. Danielle, thanks so much for joining us.
It's great to be here with you on the floor in person. This is great.
Well, it's so great to have you. And I think the Fed is really a good place to start. It seems appropriate. We began the year with the expectation, or the market pricing in the expectation for what, 6 rate cuts. That's been pared down to 1, maybe none. I want to get your sense of how many rate cuts do you think we'll see this year?
So I think it's likelier than not that we will probably see 2, if not the Fed's original baseline when they introduced the idea of rate cuts, if not 3 in 2024. I realize that seems a little bit aggressive compared to what the market has been pricing in. But, you know, this really does harken back to the time heading into the financial crisis. Many of the years that I spent at the Fed, when economic cycles are at turning points, when they're at inflection points, the statisticians in Washington, D.C. have a very hard time keeping up with the change in the data because they're relying on models that only applied to when the economy was expanding. So there's a lot of reversing and revising of the data that cause us to say, oh, wait a minute, this is what was initially reported. But now we look back and we see that the third quarter of 2023, just a few months ago, we thought that we came out of that third quarter, with fireworks. And as things turn out, we actually had job losses in the 3 months that ended the third quarter of 2023. But that's not until we have the benefit of hindsight and revisions. So I don't envy policymakers at the Fed. And I think that if anything, the reason that they have kept the door open to being in more of an easing framework in 2024 is because they're all old enough to remember, gee, with hindsight, we know that we should have started lowering rates when we did back in 2008, 2009. So I think that we're at that kind of a place where the markets want an instant answer, an instant analysis to every little data point that crosses. But I think a lot of the people at the Fed, especially Jay Powell, know that they're dealing with very much data that's in flux.
But even Jay Powell has admitted that the inflation fight hasn't necessarily gone according to plan. Inflation is stickier than they might have otherwise thought. So what in the inflation data now warrants 2 to 3 rate cuts this year? Because I'm looking at March CPI was 3.5%. Core PCE for March was 2.8%. It's not at the Fed's target.
No, inflation is definitely not at the Fed's target, and we know that. But by the same token, if you look at the types of things that Fed policy can control for, and these are the kind of things that we want to buy, because it's Fed policy that says, you know what, I'm not going to buy that house. I'm not going to take that mortgage out. I'm not going to buy a new car. Car loan rates are too high. Auto insurance rates are too high. Even if I buy the car, boy, it's going to cost a lot to maintain it. The price of the gas pump's too high. And by the way, on the way home from work, I've got to go to the grocery store, and the price for food is too high. I took my kid to the doctor. The price for healthcare is too high. What am I naming off here? I'm naming off things that are completely out of the Fed's control. Completely out of the Fed's control. What we call at QI Research non-discretionary inflation. This is the price pressures that U.S. households are seeing for the essentials in their budget. That's running at 4.7% year over year. It buries what we're seeing on what we call the discretionary side, where in fact we're seeing deflation in goods prices. We're seeing falling prices because families are having to pay so much more for what they absolutely must buy, that the things that the Fed can control for, they're completely out of the Fed's control, and those prices are falling.
So if those sources of inflation are out of the control of the Fed, how do we bring those prices down?
Well, that's a darn good question. That really is. That Americans spend too much on healthcare. Wow, that we could spend an hour here talking about that, right? Food prices, the vagaries of Mother Nature, energy, what's happening in geopolitics. These are very difficult situations for American households, precisely because it's difficult for anybody to take control of them. When you think about an insurance company, maybe 18 months ago, 2 years ago, they were asking for these great big increases in auto insurance rates. It takes a long time for an auto insurer to get clearance to do that. So what we're seeing today with auto insurance rates has to do with record car prices that we're no longer seeing. So very difficult question that you asked me, because so little is outside of a government edict or a government mandate. It's very difficult to get these things under control.
But the Fed doesn't itemize and say, well, we can't really control the cost of auto insurance, so let's take that out. I mean, they'll look at the core, right?
They do look at the core, but just to give you two, the Fed looks at super core inflation. That's something that we've all had to put on our radars. And if you look at that, that's 28% of the CPI. The only larger input compared to the super core, which is the headline CPI minus food, energy, and shelter. The only other larger input is shelter itself, which is 34% of the CPI. But to my point, if you look at what supercore inflation did in our most recent print that we saw the data across, 50% of that was auto insurance and auto repairs. 50% of the increase. So when you hear inflation is sticky, you have to understand that it might be sticky, but it might be sticky for things, again, that the Fed cannot control for. I promise you that the PhDs, 700, 800 of the PhDs at the Federal Reserve, they are right now looking at different sources of inflation. And that is why the Fed is being a little bit more dovish in its view of, gee, we're in May, and there's a long runway between May and the holidays at the end of the year and New Year's, and a lot can change between now and then that's going to change their viewpoint, especially when it comes to the job market.
So, and I want to talk about the job market and the overall economy for just a second, but I just want to home in on what gets us to those 2 to 3 rate cuts. Is it that the Fed starts excluding some of those things that they cannot control? Is it that they they change their target from 2% to a little bit higher? Or is it that inflation comes down?
I do think that inflation will come down, but not by anything but force. If you listen to the CEO of Walmart, and he's got his eye view on so many households. If you listen to what he's seeing deflation for meat and for produce prices. A year ago, he was saying he was seeing falling prices for packaged goods, and we had the shrinkflation that was therefore taking over the discussion. But he's actually seeing prices come down because American families, they're not substituting from filet mignon to grilled chicken. They're actually substituting away from meat overall. So when you see that, then supply and demand takes over. Then if you're Tyson Foods, you're having to close plants, which they are. You're having to lay off workers, which they are, and you're having to reduce the prices for the things that you're selling, even though you can't control for what a hog price is on the Chicago Board of Trade or what it costs for cattle. It doesn't matter. If people are not buying what you're selling, you have to bring these prices down, and that's what we're seeing.
We did see that from McDonald's recently, Coca-Cola saying that especially the low-income consumer, customer, they're stretched and they aren't necessarily going into McDonald's. They're going to the grocery store instead. So they're very thoughtful and prudent about any more price hikes. But I'm curious about your take on the consumer, because we all feel the pressure from inflation. But are you surprised at how resilient the consumer has actually been in terms of their spending? Because we see it in the retail sales data. We see it from some of the payment companies like Visa. We hear it from the airlines. People are continuing to travel. Are you surprised at how resilient they've been given all the pressure?
So I'm not surprised when you consider that very belated revisions that we're seeing to payrolls also tell us that the savings cushion is not as high as we thought it was. And the saving rate is as low as any time we've seen since 2007, when people were pulling billions of dollars out of their home equity to use that to fuel spending. What we're seeing instead today is that Americans, I have to be careful here, Americans had been so confident that they were spending a lot on their credit cards, hoping that the income gains would follow through and allow them to spend beyond their means because they've been told, well, gee, the job market is white hot. That is part of the Fed's mandate, right? They have an inflation mandate and an employment mandate. And it looks like the average household has finally, with this latest data on consumer confidence, the household is finally saying, oh, wait a minute. Those income gains I've been planning for, the income gains that allowed me to buy that plane ticket when I should have maybe driven with the family on spring break, I shouldn't have spent that money. And that's what we're seeing with consumers' perceptions now of, gee, if I lose my job, if my spouse loses their job, there's not another one behind it. And that's a massive change that we saw in last week's report on consumer confidence, with Americans' confidence in the U.S. job market dropping to the lowest since 2011.
But there's a difference between how consumers feel and what they actually do. So
Absolutely.
We have been seeing confidence sentiment numbers declining, but yet they're continuing to spend. So do you expect to see a meaningful pullback soon?
I am, and you're seeing it in first quarter car sales that have come in below expectations. You're seeing it with the head of Southwest Airlines saying, gee, we're not seeing bookings for airlines going out into the summer months as we would expect to be seeing at this point. We saw a company named CoStar that follows the real estate industry. We saw them come out and say, wow, we haven't seen hotel occupancy falling like this in years and years and years. So you are seeing evidence of U.S. households not planning to spend that money, or you wouldn't have Southwest pulling flights, pulling flight patterns, pulling out of gates, and hotels starting to run big. I just got an email a few days ago from a hotel I'd never thought I'd see this from. The third night is free. I'm like, from that hotel? You've got to be kidding me. But again, it's a sign of the fact that the top line revenues are being squeezed where they hadn't been when so many Americans were doing buy now, pay later and revenge spending. And they tell us that there might be a wage price spiral, but they're not seeing that on the ground. So Americans are not planning to spend money. So we're actually watching what they're not doing when it comes to looking forward to school getting out and vacations that are not being planned.
So you think that has to do with the fact that they're all out of savings, or that they're not confident about their job?
Both. It's a combination of the two, especially because it's not a natural state for U.S. households to be spending more to service their non-mortgage debt. And that's something that we saw, a month ago. We saw that the cost to service any kind of, whether it's an auto loan or your credit cards, actually is more than what it costs to cover the cost of your mortgage. So highly unusual, but with credit card rates at 21, 22%, after a few months of spending beyond your means, you're starting to get the statement in the mail and saying, whoa, I'm not even moving the needle. All I'm doing is covering the interest charges.
Mm-hmm. What is your view on the labor market? Because we've spoken before. We spoke late last year. I know you believe that the economy is already in a recession, right?
Yeah, and that was not a very comfortable place to be at all. What we're seeing is a reflection of a survey of about 700,000 employers in the country. It is a broad survey. What we get when we have the revisions to the data, which we recently got through the third quarter of 2023, we find out from 11.7 million employers, much larger pool of survey respondents, that actually that positive job growth that was reported was negative 192,000 through the third quarter of 2023. So for everybody who thought I was kind of crazy and needed to be carted off in a straitjacket, we're actually seeing with revisions that jobs actually did begin to be lost in last year's third quarter. And my goodness, what we've seen in terms of, the CEO and the CFO race to the layoff announcements. We're going to report our earnings and they're going to be stronger earnings. Why? Because we're laying off so many people. January is typically a month that you see come in with massive layoff numbers. And we saw that about 104,000 layoffs were announced in January. That's gone straight to the bottom line of a lot of companies that have surprised to the upside during the most recent earnings season. And then we saw a really high number in February, and then March, both almost 80,000. And then April, 120,000 layoffs announced in the month of April, which is usually kind of a friendly month for the job market. Now we're going off of seasonal patterns. Now's when you start to really get the attention of people like Jay Powell. Maybe he's not going to say it publicly, but somebody saying, sir, we've gone off the seasonal trend line, and we've got major layoffs coming through in April into the spring when it's not normally something we would see.
But we haven't seen those carry through to weekly jobless claims. So doesn't that suggest that the unemployment might be short-lived and people are able to find other jobs?
Well, that would be the case if we hadn't had, for the past 12 months, 25% of the U.S. pool of unemployed workers be considered long-term unemployed. In other words, they've been looking for a job for 6 months or more and not found one. That's becoming highly, highly, highly problematic. I hear it from my friends who are career coaches. You know, they look and they're on Indeed.com and LinkedIn, and there appear to be all these job openings, but nothing's coming through for them. And you're seeing more and more media outlets report on, gee, this college graduate sent out 1,000 resumes and not seen anything. That's what happens when your permanent job losses begin to accumulate and stay where they've been. A quarter, 25% of the unemployed have been looking for a job for 6 months or more. That's when you start to have word spread on Main Street, as opposed to just with wonky people like me who are following the data very closely. It's one thing when I know it's coming. It's a whole nother thing when there's a realization on Main Street of these phenomena.
How concerned do you think we have to be that AI will eventually replace jobs and lead to more layoffs? Because companies right now say it's not going to replace, it's going to elevate. We saw Jensen Huang, the CEO of NVIDIA, on 60 Minutes say, no, AI helps make companies more productive. That increases earnings. Increased earnings mean companies hire. People aren't saying that it's going to replace jobs, but it's certainly the fear.
And it's actually happening. So there is a quarterly survey of chief financial officers, CFOs. They were asked in the most recent survey, are you using AI to mitigate your labor costs? And for the largest companies in the country, half of them were indeed doing that. So they were replacing humans with artificial intelligence. And of the smaller companies, it wasn't so prevalent, but there was still a good chunk of, still a good third of them were also using artificial intelligence to replace workers. And that is, it's kind of a simple fact of life if we're starting to talk about car sales falling and vacation planning falling and what have you. If you're running a company in theory to make profits, then you have to cut costs where you can. So I look at AI as being something we have to survive initially. So it's going to replace workers. And on the other end, it's going to make all of the workers in the workforce that much more productive and be beneficial and work its way through education and into the workforce. But for the moment, with companies in a cost-cutting mode, it's working the other direction, with deference to the CEO of NVIDIA.
Certainly a lot of headwinds for the economy and for the Fed as it kind of tries to maximize employment, but also stabilize some of these prices. So what's the takeaway in terms of where we go from here? I want to talk about market implications, but just in terms of the overall economy, how, if we really are in a recession, how deep and long is the recession, and what should the Fed be doing about it other than potentially cutting rates this year?
So I think it would help the Fed to reiterate their independence and to say, if we're seeing more weakness in the job market, maybe even come out and communicate through other indicators. It's not flowing through to initial weekly jobless claims. But then initial weekly jobless claims have been in such a steady state for so many weeks in a row with 166 million workforce, you have to start to say to yourself, statistically, the Department of Labor is having a little bit of trouble with their models. And these numbers aren't reflecting the reality of what we're seeing on the ground with layoffs that are being announced. But I think it's incumbent upon the Fed to be a little bit more upfront with the public about their independence and saying, we know it's an election year. If we still feel that we need to cut rates, even if we're close to an election, we're going to go ahead and cut rates. And if nothing else but to communicate that during a very politically divisive time, that they're going to look at their job of safeguarding the American public and the U.S. economy, that they're going to stick to their duty, regardless of what may or may not be happening with the presidential election or as we get closer with that of the Senate and the House of Representatives. So I normally wouldn't say these, I normally wouldn't make these kinds of comments, but I worked there for 9 years, and if you're an independent, apolitical institution, sometimes you have to take the lead in communicating to the public, especially when so many politicians are telling U.S. households, oh, that inflation's a figment of your imagination, or oh, there's tons of jobs out there to be had. But the frustration on the household level is like, I'm not seeing it. Still costs too much, and I can't get a new job.
So what does all of this mean for the market, the stock market? Mm-hmm. Where does it go from here?
So I think that right now, the reason that we're seeing so much back and forth in markets, it's like we're having a great rally today. Whoa, we just pulled back. I think the tug of war that we're seeing has to do with top line risk. So the same way the Fed cannot control for the price of essentials, the same way monetary policy can't sway the price of essentials one way or the other. If you're in the C-suite, you can control for your bottom line. You can cut costs to shore up your profit margins. There's nothing you can do about top line. And that's kind of, I think, where we are, where it's more top line revenue that's at risk that investors should be paying attention to going forward and looking for areas of the economy that are going to be a lot more bulletproof, whether or not it's baby boomers in need of a certain kind of health care. And you're going to have to be very choosy as investors with saying, this company's not at risk of cutting their dividend. So come what may, if I'm going to have to ride out the storm of maybe it finally seeing a sustained pullback in the stock market, at least I'm still money good in terms of what the dividend production is coming out of this company.
So you mentioned healthcare, you mentioned dividend. Are you saying now is the time to be defensive?
I think it is incumbent to be defensive if Americans are cluing into the weakness in the job market, because this is when your consumer discretionary sector is really at risk. This is when you're seeing so many retailers close up shop. You're seeing increased transaction volumes in commercial real estate, and that's going to be also pose a risk, I think, for many of the banks that have been in a holding pattern, hoping the Fed's going to go back to zero interest rate policy. Forget about a quarter percentage point rate cut here and there, or maybe just one in 2024. A lot of the banks have been operating saying, God, we need to get back to the zero bound and we need to get back there quickly, or we're going to start recognizing losses. And I think we've kind of started to turn that chapter, given what my friends in commercial real estate are saying.
But here's the thing. This is a market that has priced in higher for longer rates. It's had to come to terms with the fact that we're not likely going to see 6 rate cuts, at least according to what the Fed's saying right now. It hasn't priced in a recession because often people think that this is a pretty resilient economy, a resilient jobs market,
and that is indeed what all of the sell side says. And that's what sell side banks do. They say it's resilient.
But what does pricing in your thesis look like?
Again, that's when you start to see companies warning on the top line. And when you see that, and especially if the Fed's narrative shifts a little bit towards, we're a little bit more cautious, we're starting to lean closer towards our employment mandate, as opposed to saying it's only about inflation. When markets understand that a rate cut's actually coming, that's when things tend to turn.
So what does that look like?
A turn in the markets? It looks like a correction that holds, as opposed to this constant back and forth that we're seeing, where you don't know, you can't turn off the financial media for a single day and even begin to think it's going to be quiet. It's either going to be up or down or big. Then the correction holds.
The warnings on the top line, are you seeing that in this earnings season?
You are seeing companies saying that we are reducing prices. You are seeing that. It's coming with the layoff announcements as kind of a cushion to what they're saying, but you are seeing companies saying, we had expected by now to be coming out of this, and we're not. We saw some numbers come out of the Chicago area. It's the Rust Belt of the country. It's the industrial heartland. We saw numbers come out of Chicago last week that were simply nothing like you've ever seen unless you're deep inside recession. Commercial and industrial lending has turned negative year over year. Again, you don't see these things unless you're already in recession. And I can't dictate what banks are or are not doing, but we do know from weekly data out of the Fed that commercial and industrial lending has turned negative. So lenders, even if lenders are saying the economy is strong, the consumer is resilient, if they're not following through and making a loan, listen to what they do, not what they say.
So are you comfortable putting money to work right now? Are you comfortable buying stocks at all, aside from maybe some income dividend plays?
And I will tell you that I'm not selling my income dividend plays because I feel confident those dividends are safe. But other than that, I feel that it's prudent to be in a very defensive mode at this point, depending on where you are in your career. You're still getting paid in what the Fed is doing, not what the Fed is maybe even potentially going to say if they're going to become more deficit. So you're still getting quite a fat return on your cash. And there's something to be said for the comfort of sleeping at night and knowing that you're able to be a spectator. You know, have a beer, eat some popcorn, watch from the outside, and see whether or not maybe we're going to get past the election and there's going to be a huge hiring spree. But right now, regardless of the outcome, you're being paid to wait. It's not sexy. I understand that. But if you don't feel like your income stream is safe in the stocks that you own, I don't think right now that you're getting paid to take on extra risk, whether that's high yield bonds or the stock market.
What about tech? Given current valuations, would you be, even some of the big tech companies, you talk about AI displacing jobs, it's clearly not going away right now. Would you put money to work there?
The ones I wish would stop firing people are the biggest players in Silicon Valley. We just had another big announcement out of Google. So I'll feel more confident in tech when tech feels confident enough to stop firing people. And we have indeed seen it started in November of 2022 with Amazon, but it's kept going since then. And what I'm hearing from my colleagues on the West Coast is there is a lot of money in people who've become millionaires overnight by holding NVIDIA stock. They're buying homes, but that's very much a specific to that particular area. And if you were in the right stock at the right time, which is reminiscent of the dot-com era. But if you're not, and you're not seeing your spouse or your neighbor get a new job, that's going to make people more cautious.
Okay, so we're just about out of time. So I want to give you just the final word. What's the key takeaway for investors?
I think the key takeaway for investors is that once there is recognition on the part of U.S. households, once people's perceptions of the job market are the weakest they've been since 2011, it's hard to get the genie back in the bottle. It's hard to convince households when they think the job market is in recession. It's hard to convince those households to splurge and spend on what they wouldn't otherwise. And that's my bottom line, is that you got to watch the top line.
All right, we'll keep an eye out for that. Danielle, thank you so much for your insights. Really appreciate it.
Thank you.
It's going to do it for Market Overtime. I'm Caroline Woods. Be sure to download the Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. Thanks so much for joining us.